So let us continue discussing case scenario number 4. ABC Limited, a UK firm, has a receivable of 20 million due in 6 months. The company wants to cover full exposure. Following information are available. Spot rate $1 is equal to pound 0.7720. Okay, bid rate 0.7840, offer rate. 6 months forward rate is given. Now, this is a UK based firm. This is a UK based firm and quotation given for $1. Direct, indirect quota, direct quote. That you need to remember. Now, next, interest rates are as follows. They have given the interest rate also. 6 months deposit rate given, borrowing rate given, and 6 months, okay, US deposit and borrowing rates given, as well as the UK deposit and borrow rates given. Now, following options on pound are available. This is from, okay, exchange options. They have given these things. Okay, call option is available at a strike price of 0.81. And what is this price? Is nothing but premium. So if you want to pay the call option premium, 0.01 pound. Okay, for $1 option. Like this, you need to interpret. This is nothing but, see, this is nothing but, okay, $1 option. $1 option, okay, is available at a strike price of 0.8100 and at a premium of 0.01. Are you all understanding now? This is there. Then there is a put option. Okay, strike price and premium given. Now, ABC Limited has forecasted the spot rates for 6 months as follows. Future rates of dollar given. Okay, future rates of $1 given. Okay, 30% probability and given. Respective future expected future rates given and the probability for the same is also given. From the information given above, choose the correct answer. Anyway, we'll see the questions here. What will be the total expected value of option hedge in pounds if the full exposure amount of 20 million is covered? See, very simple. Okay, this is basically the question is all about call option and put option, the option, currency option question. Now, if you want to hedge in pounds, okay, a full exposure amount 20 million is covered. Now, what do you need to do? Very simple. See, what is your exposure amount? Is 20 million dollar. Dollar is $20 million. Okay, the foreign currency in for UK based firm is dollar. What do you say? The entire 20 million, if you want to cover, first of all, okay, you need to ascertain whether you need to take. I told you the currency option and futures question, you need to ascertain what is the strategy, whether you will sell dollar or buy dollar, which means you sell the, if you want to sell the foreign currency in future, okay, and the quote is available for foreign currency, what you should do, you should take a put option. Put option will give you right to sell. Are you all understanding? And the call option will give you right to buy. Okay, in case if you want to buy the foreign currency in the future, okay, you have to buy what you have to buy. You have to take call option. You have to take call option that I told you. Now, for example, in this case, UK based firm, it has receivable of foreign currency receivable. Are you all understanding this? Foreign currency receivable. Here, foreign currency is dollar. The UK based firm has dollar receivable. Agreed. Now, the dollar, okay, after receiving the dollar, he will sell dollar, he will buy dollar, he will sell dollar. Are you all understanding? He will sell dollar in the future currency. Now, I should take call option or put option. I will take call option or put option. Put option I will take because I want to sell now. So I want to get a right to sell. Are you all understanding? So 81 will be the strike price and 0.02 will be the premium amount. The 0.02 will be the premium amount. One more thing is that provided the quote should be direct quote. Okay. Because the quote, okay, here it is exchange. The option is also a quote for currency. Which currency? Okay, dollar option is given. So the quote for dollar option is given now. So you have to take the put option. Are you all comfortable? First, you select the option to be taken. Thereafter, what you should do? You should, okay, find out the value. So how to compute the value? Very simple. What you should do? Okay, you should check the, okay, exercisability. Very simple. 0.78 in first option. 0.78 is that you will compare. This is like FSP. Future spot price. I told you in the option. You compare with 0.81. 0.8 in the strike price. So the currency worth 0.78. You have a right to sell at 0.81. Will you exercise your right? Yes, I will exercise my right. Next case, if it is 0.81 and the strike price of the put is also 0.81, okay, you can assume that it will be exercised. Exercise or lapse, both will be same. Okay, you will take 0.81. Are you all understanding? The third situation, okay, currency worth 0.83. Okay, you have a right to sell at 0.81. Now you will lapse it, which means you will sell at 0.83. Are you all understanding? So what I will do is that there are two ways. I'll just explain what you have the exercise price. You will take the selling price, respective selling price. So 0.81 I will consider. Here also I will consider 0.81 because both are same. Here I will consider 0.83. Are you all understanding? Here I can mark it. This is 0.81, 0.81, 0.83. Now what I will do? The 200 lakhs is there, or 20 million or 200 lakhs there now. Into 0.81 I will do in the first case and apply the respective probability of 30% into 0.3 I'll get some value. Okay, like this, I will do 200 lakhs into 0.81 into 0.5 is equal to, okay, I'll find out 200 lakhs into 0.83. Here the selling price will be different. Okay, right, to sell at 0.83 higher rate. Now you lapse the contract and exercise at 0.83 into probability 0.2 you will apply. You will find out the total of this amount, then reduce the premium amount. Okay, premium, how much you paid? 0.02. Okay, 0.02 of the 20 million, let's say 200 lakhs into 0.02. Okay, how much is that? 4 lakh pound. So 4 lakh pound, you will reduce the premium and you will get the balance amount. Are you all understanding? You have taken a put option. Okay, you have taken a put option. You have to pay the premium and you will receive this cash flow. The receivable amount will be this much. Now, shall we compute this 200 lakhs into 0.81 into 0.3? How much is that? 48 lakh 60,000. Then you have 200 lakhs into, okay, 0.81 into 0.5. How much is that? 81 lakhs. Then you have 200 lakhs in 0.83 this time into 0.2. Okay, you get 33 lakhs 20,000. If you add these numbers, okay, plus 8 lakhs plus 48, get 16 lakh, okay, 162 lakhs 80,000. Are you all understanding? So 162 lakh 80,000 minus the premium just now. This is in pound and minus 4 lakh pound. Are you all understanding? So you will reduce the 4 lakh pound. You will get the balance 1588. Okay, this is 158 lakhs 80,000. That is, I think 15.88 million. The C is the correct answer. Okay, now the same way you can also do. Okay, one more method is given in your institute module. That is also will give you the same answer. Very simple. Before applying the probability, okay, what we have done in this, premium separately taken. In the solution also for this MCQ given like this. They have taken the premium separately and shown like this. Okay, both are same. Here you have taken 0.81. Now, what do you do? Every time when you compute the inflow amount, which you take na 0.81, there itself you adjust the premium, which means 0.02 is the premium now for respective amount. So very simple, yeah, 200 lakhs into 0.81 is the amount, okay, is the selling price, minus 0.02. What is that? 0.79 into 0.3. Like this, if you compute, also you should get the same answer. Okay, let us verify also. 0.79 into 0.5. 200 lakhs into 0.83 na, into 0.81 into 0.2. Are you all understanding? If you do the total of this, okay, how much you are getting? Let's say 200 lakhs. Now you don't need to separately reduce the 4 lakhs because already we have computed we have adjusted the 0.02, okay, the premium amount. So 200 lakhs is there into 0.79 to 0.3. That 4740. The next 200 lakhs into 0.79 into 0.5. Okay, 79 lakhs. Then we have 200 lakhs into 0.81, 0.2. That 32. Okay, if I get if I total it, I get 158 lakhs 80,000. Give the same answer as this one. Are you all understanding? Comfortable? Next, if ABC Limited using forward hedge strategy, what now? See the question here. I will say here we will see. Okay, in the future whether they have given anything regarding the interest rate. Really speaking, okay, see what should be done conceptually. The premium which you pay is on the initial date. Okay, initially you pay the premium at the inception of the option contract. But okay, the payoff which you receive from the transaction, real transaction, will happen on the maturity date. Are you listening? So the premium and the maturity cannot be simply added or subtracted. Time value of money, really speaking, we cannot do that. This 4 lakhs, I'll tell you what happens here. The 4 lakh premium which you received, this you cannot directly deduct from this. This will be giving a wrong number. Are you all understanding? Really speaking, the 4 lakh, okay, should be compounded and using the respective interest rate. Are you all understanding what I'm trying to say? Which means the borrowing rate prevalent in the UK, you will consider, this is a US based firm, a UK based firm, I think UK based firm. So here UK interest rate is given. Okay, 6 months borrowing rate given 7. Yes, what is that? 7.5% given. That you should consider and compound till the option maturity period and compound the premium to the future date and then subtract from the value, because this is maturity date cash flow and this is initial cash flow. You should compound, really speaking. And okay, this in the institute material, okay, the past examination question also, they have done the compounding. If you see in the study mat, one of the descriptive question is available. There they have compounded the interest. That's why actually interest is given. Conceptually, interest has to be taken to compound to arrive at the final number. Are you understanding? The payoff and the total expected value of option hedge. When you do option hedge, okay, the opportunity cost of the premium paid for the option should also be considered. Here, they are not considered. Interestingly, that's the anomaly. Okay, the institute, the material which are taken from which the study, the MCQ question has been framed, there the interest has been considered, That is why interest rate has been given in the question here also, I strongly believe, but they have not considered in, okay, I don't know why they have not considered. Anyway, this is the issue. Are you all understanding? Calculation also, if you see this, okay, that is why I'm very skeptical about these, you say, the institute solutions here. They don't, okay, do it uniformly. The one question they do this way, one question they do another way. See here, question number 4, what they have done now to get the payoff, they simply did this 0.81 into 0.3, 0.81 into 0.5, 0.83 into 0.2. If you see the study mat, they have adjusted for respect to premium also. And then, okay, here they have deducted the premium separately. In any case, okay, they have not considered the interest lost on premium, interest on, okay, premium, which is opportunity cost, should also be considered anyway, not considered. Okay, that's why. Anyway, that is there. This is the problem in this question. Anyway, next question number 2. If ABC Limited is using forward hedge strategy, what will be the total proceeds in pound? This is very simple and straightforward. See, it doesn't go for option. Currency option only is, okay, little bit tricky. Not the forward hedge. Now you see forward hedge, 6 months forward rate, okay, given in the question, you will consider. Now, here, $20 million receivable. Okay, so foreign currency receivable. Quote is also given for dollar, na? Direct quote. You tell me. Okay, foreign currency receivable. You will sell dollar. You will sell dollar. Bid rate, offer rate. Okay, bid rate should be considered 0.7910. What is that? 0.7910. Which means, what is that? 20 receivable amount is 200 lakhs. $20 million. 0.7. What was the number? Forward rate? 0.7910. How much is the amount? 1582. Okay, D should be the solution. 15.82 million. This is the forward rate. Are you all comfortable? Okay, D is the solution. Now, next. See, what will be the expected spot rate at the end of 6 months and expected cost? Okay, if no hedge strategy is adopted by the company. Okay, what will be the expected spot rate at the end of 6 months and expected cost if no hedge strategy? Now, see, very simple here. The rate we have to consider. Now, this you apply the probability. Very simple. Yeah, you apply the respective probability, find out the expected spot rate. So, which means let's say 0.78 into 0.3, okay, plus 0.81 into 0.5, plus 0.83 into 0.8. Okay, how much is that? 0.805. I get 0.805, the first number. Any other option? Not there. And 200 million if 0.805, na 200 lakhs into 0.805. How much is that? 16.110 million. Are you all understanding? This is the solution. Next, identify which option gives the highest proceeds. Now, see, no hedge option, I know what is the proceed, 16.110 million. Okay, forward hedge gives a, okay, receivable amount. So you have to select the highest inflow, 15.82 million in pound, and you have 15.88. So which is the highest? I think no hedge option is the highest. 4D should be the solution. Are you all comfortable? No hedge option is the best option. Okay, next. Case scenario number 5. P Limited is considering a new project with the following details. Initial project cost 4,80,000, annual projected sales 4 lakhs, annual projected variable cost given, fixed cost, project life given, cost of capital given, and present value annuity factor for 4 years at 10% given, 11% given. Ignore depreciation on initial project cost and taxation. Okay, very simple. Ignore depreciation as well as a tax effect or cost. Calculate up to 2 decimals. Okay, now let us start answering one by one. If initial project cost is varied adversely by 10%, what is the percentage change in NPV? Okay, this is a sensitivity analysis based question. I told you how much, if the project cost, they have given various details, right? Project cost is given, which means initial project cost. This is nothing but discounted cash outflow given. Then there is sales given, variable cost, fixed cost, ignore depreciation, which means the profit, whatever is the sales minus this cost, okay, will give you the profit. The profit is equal to cash flow. That is the assumption. So 4 lakhs minus 2,20,000, 1,80,000 is the annual cash flow, which means there is outflow, there is annual cash inflow, then there is project life, and there is cost of capital. 4 factors may affect the NPV of the project. What they are asking now. Initial project cost is adversely varied by 10%. What will be the impact in the NPV? To know the impact in the NPV by these factors, first you need to calculate the base NPV. First you need to calculate the NPV from the data given above. Are you all comfortable? So which means what I will do, initially I will find the NPV. This is annual cash inflow. This is annual cash inflow, 1,80,000. Outflow, see, NPV is equal to what? Discounted cash inflow, DISCI minus DISCO. Discounted cash inflow minus discounted cash outflow. Here, discounted cash inflow, I need to find out. Original cost of capital at 10%. Now, what is the annuity factor? 3.169. So, 1,80,000 is the annual cash flow. 1,80,000 to 3.169. How much is that? 5 lakh 70,420 is the discounted cash inflow minus outflow year 0. So the present value factor will be 1. So 4,80,000 will be the value. 5,70,000, 80,000. I get NPV as 90,420. Are you all understanding? This is the base NPV. Okay, this is the starting point. From here, I will try to find out the impact of the NPV by these factors. Okay, which means whatever is asked, we will try to find out. If initial project cost, yes. Now tell me, what is the initial project cost? 4,80,000. What they say? If this is impacted adversely by 10%, so just imagine if the cost is impacted by adversely by 10%, it should increase, it will decrease, it should decrease, it should increase or decrease, increase. Now, if cost, if increased, then only it will impact adversely. If cost reduced, now it is favorable to you, which means 4,80,000 cost. Now, if increased by 10%, which means I put 110% into 110%, 4,80,000, 110%. How much is that? If cost becomes 5,28,000, what is the NPV? Revised NPV. Then you will find out the percentage change in the NPV to find out the sensitivity in percentage. When you find out the sensitivity, you should assume that one factor you are trying to find out now. For example, in this question, they have asked the impact of the cost, right? So other factor will remain same, which means you won't alter the cost of capital or the, the project life or the annual cash inflow. All the other factors will remain same, which means I already computed the annual cash inflow, discounted cash inflow, how much? 5,74,20. Discounted outflow becomes 10% higher. Now I will reduce this 5,70,000. 5,28,000. What I got? 5,28,000. Okay, the discounted cash outflow I will change now. So I get 42,420 as the revised NPV. Earlier the NPV was 90,420. That dropped to 42,420. Are you all understanding? Now I want to find out percentage change. Therefore, percentage change is equal to how much? See, 90,000. From where? How much is the difference you take in numerator? 90,420 minus 42,420. How much is that? 420. Oh, 48,000. Okay, this is 48,000 divided by what? From where? See, the denominator you should always consider from where it dropped or increased. So what is the denominator? 90,420. Okay, from there only it falls now. So 48,000 divided by 90 value 53.30. Yeah, 53.085. 53.09. I think 53.09. Are you all understanding? Okay, C is the solution for this question. Okay, next. If annual cash inflow is varied adversely by 10%, what is the percentage change in NPV? Next to what they're asking, see, the cash outflow you will keep same, but annual inflow is varying by 10%. Very simple, yeah. At present, what is your inflow? You see, what is the inflow and the cash inflow? Now, here depreciation, since it assumed like that, so we will assume the profit is cash flow, which means how much is the profit? Very simple, yeah. 4 lakh minus 2 lakh 20,000, I believe. Let's check. 4 lakh is the, yes, 4 lakh is the sales minus cost is 2 lakh 20,000. So 1 lakh 80,000 is there. This is the annual cash inflow. Nah? This 1 lakh 80,000, okay, is the annual cash inflow. It varies adversely by 10%. Now you tell me if this is the profit amount or cash flow. Varies adversely means it is increasing or decreasing, or it is decreasing. If it decreases by 10%, so what you should do? 1,80,000 into 90%, into 90%, because it drops from 10% from 1,80,000. How much is that? 1,62,000, which means the annual cash inflow becomes revised and annual cash inflow becomes 1,62,000. Now, what is the impact of the NPV? Shall we recompute the NPV? First, we need to find out. See, original NPV 90,420. This you should keep in mind. Revised NPV will change because 1,62,000. If you apply discounted cash inflow, annuity cash flow is annuity factor. How much? 3.169. So, what is that? 3.169. 1,62,000 into 3.1. That 513,378. This is the annual cash inflow. 513,378. Minus annual cash outflow, not the one which we computed in the first part. You should take the original annual cash outflow, 4,80,000. I told you, you should keep other factors same. Otherwise, you keep on altering everything, you will not get the same number. Are you all understanding? So 5,13,378 minus 4,80,000. Let's say we've got 33,378. Are you all understanding? Now NPV dropped. This is the original NPV. Now the revised NPV, how much? Okay, 33,378. What is the percentage drop? We need to check. 4,9,420 minus 33,378. Okay, divided by. Okay, it dropped by 57,042 divided by 90,004 percentage, 63.09. 63.09. Are you all understanding? C is the solution. Very good question. See, the previous question itself, okay, I should mark it as important. In this question regarding currency option, I forgot to mark it. Very, very important. Good question. Okay, you can try. Anyway, this question is about sensitivity analysis. This question is also important. Okay, see. Now, next, question number 3 in this. If cost of capital is varied adversely by 10%, what is the percentage change in NPV? Very simple. I was wondering why they have given two cost of capital. This is the reason. What they say, today cost of capital is 10%. What they say, this 10% increased by 10 more percentage. Very simple. Yeah? 10 into 110%. How much is that? 11%, which means 10% becomes 11%. All the other factors remain same. What will be the impact in NPV? Okay, 11% present value annuity factor given in the question, we can consider that 3.103. This you will change. Okay, so cash inflow is how much? 1,80,000 into 3.103. This is 558, 558, 540. 558, 540 minus 4,80,000. Are you all understanding? 78,540 will be the revised NPV. Original NPV was 90,420. See what happens here. NPV is nothing but discounted cash inflow minus discounted cash outflow, net present value. I told you, whenever you increase the discounting rate, okay, higher the discounting rate, value will be lesser, the present value will be less, and lower the discounting rate, value will be higher. In this case, what happens? If cost of capital increased for the company, okay, because NPV, the discounting rate should be used, cost of capital should be used as discounting rate, hence value will get reduced. That's why it is getting adversely impacted. So 90,420 NPV dropped to 78,540. I'll find out the difference here. What is the difference? Okay, 11,880 is the difference. So 11,880 divided by 94. What is the percentage? 13.13 or 14? 13.138. 13.14. C is the solution. Are you all comfortable with the case study? Shall I move on to the next case scenario? Take case scenario number 6 now. Fair Return Mutual Fund made an issue of 5 lakh units at 10 each on 1st April. No entry load was charged. The fund made the following investments. Okay, these are all the investments made by the fund. 25,000 equity shares of 100 each at 160, 7% government securities at par. Okay, 9% debentures also issued at par and 10% debenture listed at par, 2,50,000 total. Okay, the fund made an investment to the extent of 49 lakhs. Initially, it received how much? 5 lakh units of 10, now 50 lakhs rupees it received. Out of this 50 lakhs, it made an investment of 49 lakhs. 1 lakh is the cash balance. You should understand like this. During the year, dividend 6 lakhs was received on equity shares. Interest on all type of debt security was received as and when due. Operating expenses paid during the period was 2,50,000 paid during the year, which means it will affect the cash balance. Okay, now at the end of the year, equity shares and 10% debentures are quoted at this much equity shares and 90% is the debenture value, and all other investments are valued at par. Okay, this type of question is there in your past examination question and your RTP as well. I think you can go through. Okay, what is the net cash balance of the mutual fund at the end of the year? Very simple. Opening balance 50 lakhs I had, and I made investment of 49 lakhs. 1 lakh rupees I have the balance. From here, what I will do, see, I have received what? Dividend of 6 lakhs. So this 6 lakhs will get increased plus 6 lakhs. Plus, apart from that, you receive all the interest from the fixed income security. So 4 lakhs into 7%. Lakhs into 7. How much is that? 28,000. Okay, so 28,000 will be there. Then apart from that, you have two more instruments now. What is that? Okay, 9% debenture. So 2,50,000 into 9%, 22,500. Okay, 22,500. Apart from that, you have 2,50,000, 10% debenture, so 25,000. So all these fixed income security will give you interest now. That also will include, what is the total amount? 7 lakhs. Okay, 7 lakhs plus 28,000 plus 22,500 plus 25,000. 7 lakh 75,500 minus the expenses. What is that? What are all the expenses paid? 2,50,000. Okay, minus 2,50,000. How much is that? 525,500. 525,500. Okay. Are you all understanding? So D is the solution. Next, what is the total NAV of the mutual fund at the end of the year? See, this is the cash balance. 525,500 is the cash balance, and you will keep on adding the securities balance, whatever is that market value, you will calculate. So 25,000 equity shares of 100, what they're saying, it is trading at 190, 175, what they've told, 175% of the face value. Here, one mistake, I've seen a common mistake here. You should not apply the 170 percentage from 160. Okay, this I've seen. That is why I'm saying, not ordinarily you will not do, but exam condition you may commit the mistake. The 100 rupees is there now. This is the face value. From here only you should apply the 175 to the market value. So 175, 100 into 175% is 175 into 25,000. So 25,000. How much is that? 43 lakhs 75,000. So it will be valued. Equity shares will be valued at 43 lakhs 75,000. Next, the debentures will be valued at 90% of the face value. Face value is how much? 100. What is that? Government securities or what? Yes, 10% debentures. So 10% debenture. Okay, it is at par 2,50,000 if it is valued. Not 90% means how much? Okay, 2,50,000 into 90%. 2,25,000. Value at 2,25,000. Okay, that you should consider. Again, next, okay, what is there? You have other two securities are traded on par now, 4 lakhs and 2 lakh 50,000. Simply add 6 lakhs 50,000. Are you all understanding? What is the total? Okay, 2 lakh 20,000 plus 6 lakhs plus 43 lakhs 75,000 plus 5 lakh 25 500. I'm getting 57 75 500. 57 75 500. Option C is the correct answer. Okay, next. If the mutual fund distributes a dividend of 0.6 per unit during the year to the unit holders, the NAV per unit at the end of the year will be. Now, the mutual fund distributes a dividend. This much of dividend it distributes. What will be the NAV per unit? Very simple. Yeah. Opening, how many units it issued? Very simple. Initially, it issued units at 10 each, 5 lakh units. 5 lakh units it issued. So, which means for 5 lakh units, it needs to pay dividend. How much it needs to pay? 0.6. So, very simple. This you keep in mind. The 57, 75, 500 is the closing balance of the assets. From here, okay, out of cash balance, you will pay the dividend. 0.6 you will pay dividend. For how many shares? 5 lakh shares. 5 lakh into 0.6. How much is that? 3 lakh you will reduce. Are you all understanding? So 3 lakh dividend will be paid out. Balance, what will be the total net assets? Okay, how much it will be? 54, 75, 500. Are you all understanding? Divided by number of units. Okay, 5 lakh units were outstanding. Divided by 5 lakh units. 0.951. Okay, 10.951. The NAV I'm getting. Are you all understanding? We just can cross verify. Okay, what is the solution given for answer A? Okay, this is past question. Number 6. What is that? Okay, D given. Next, okay, you apply this. C given for yes, C correct answer. Then 3B. Whether we will see whether B is the right solution. Yes, 3B is the right solution. 10.951 is the NAV. Are you all understanding? From case scenario number 7, discuss in the next video. Thank you.